Okay, well, in order for me to explain what an L3C is, let's talk a little bit about the purpose it seeks to fulfill. We have in the United States 45 million people living under the poverty line, and the social sector is just inadequate to the task. Their resources being deployed programmatically do not allow for any social innovation, do not allow for growth, do not allow for the expansion of services to a greater population. So, more and more nonprofits are seeking to become self-reliant and sustainable in their own rights, not relying on philanthropy in the way they've relied upon philanthropy in the past, and not relying on government in the way they've relied on government in the past. The L3C is a reflection of the fact that more and more nonprofits are embracing earned revenue strategies, moving away from a charitable model toward an investment model. And the L3C is indeed a for-profit business form that is, in almost half the cases in the United States, a subsidiary or affiliate of a charity. And in the other half of the cases, it is a freestanding social purpose business. In order to understand the purpose of an L3C and the way it works, we need to go back to the Tax Reform Act of 1969, where for the first time, Congress imposed upon grant-making foundations the obligation to distribute 5% of their assets annually for charitable purposes. This is what accounts for the feverish competition for grants among charities. What is less understood, however, is the statutory obligation imposed on foundations can be satisfied not only through grants, but through what has come to be known as program-related investments, a special category of investment for charitable purposes. So what the L3C does, it facilitates program-related investments made by foundations. Now, why does it do that? Because an investment, unlike a grant, can be made in either debt or equity, and a for-profit business like an L3C, subsidiary of a charity, can be set up with its capital structure shored up, given an equity investment by a foundation. That equity investment can now be leveraged to attract investment from the private sector, either concurrently or subsequently. So what we have is a situation where the charity creates a business, deposits that business for an asset protection reason into a new for-profit business. That business is now funded in part by a foundation that does the heavy lifting. It bears the financial risk. It serves as a social venture capitalist where it contributes advice and expertise and infrastructure. And the foundation forgoes market rate returns. And in so doing, it thereby subsidizes financial returns to other investors who may come in later, investors who otherwise might not be interested in funding this social mission were it not for the financial return. So what we're talking here about is leverage, where the foundation is making an investment, that investment is being leveraged, and private investors are being enticed by a value proposition that is both financial and social to put money into the social problems that are most vexing facing our society. We might ask, why would a foundation prefer to make an investment over a grant? A grant is an expense. From an accounting perspective, it's writing a check, it's hoping for the best, but the money is gone, never to return again. When the foundation makes an investment, however, whether that investment is debt or equity, that investment is to come back to the foundation, presumably with earnings, to be recycled over and over again for charitable purposes. So you have with an investment a financial multiplier effect that you don't have when you have a grant, and consequently a social multiplier effect that you don't have when you have a grant. So being good stewards of the resources entrusted to the foundation's management, the program-related investment is itself gaining significant traction. When I wrote the Illinois L3C law, which took effect January of 2010, something less than 1% of the foundations in the United States were making program-related investments. As of the end of last year, that was something in excess of 7%. And this is attributable to lots of thought leadership. We now have the Gates Foundation doing program-related investments. The MacArthur Foundation has done it for a very long time. The Kellogg Foundation, the Kauffman Foundation, and others. And so are the smaller foundations, the family foundations, and the mid-sized foundations. Understand the importance of really moving the needle socially and understanding that today's economic circumstances and the depth of the social problems we face demand new approaches, demand a catalytic use of philanthropy rather than exclusively a checkbook philanthropy approach. So the nonprofit gains the advantage of using its cash programmatically, developing an earned revenue strategy which itself drives mission, and yet relies on off-balance sheet financing for the entrepreneurial risk associated with the launch and maintenance of the venture. So you might ask, what kinds of nonprofits are looking at this approach, and what kinds of examples do we have where it's been successful? Well, if you can look at the variety of missions that nonprofits pursue. Let's suppose we have a nonprofit that's concerned about issues of unemployment or underemployment, issues of supporting reoffenders, issues of supporting youth that are at risk. Well, to the extent that a nonprofit can create a venture to employ those people who are outside the economic mainstream, the nonprofit can not only diversify its revenue, relying now not exclusively on philanthropy, but also through earnings of this venture. And the venture itself can be a laboratory to employ the people who are the population to be served by the nonprofits and give them the work ethic, reportability to a manager, showing how they deal with a customer, showing how they dress to go to work, showing the discipline that's required, and building a resume so that they then can get their next job outside the safety net of the nonprofit. This works for everybody's advantage. The foundation ends up using its money more impactfully. The charity's mission is served more broadly and more deeply. Its resources are being used more cost effectively. And the population now has a real life experience that will serve it well above and beyond whatever the charity was doing for it before. As of April of 2012, the Internal Revenue Service now, at the behest of foundations, has expanded the program-related investments that are sanctioned. And we now can look at arts organizations, for example, who want to put on community art exhibits that are revenue-producing, funded by foundations. My firm has been actively engaged in putting together program-related investments in L3Cs, that is low-profit, limited liability companies all over the country now for several years. Much of this is outside the U.S. We have bottom of the pyramid being served through nutrition initiatives and educational initiatives. Many social enterprises, L3Cs and otherwise, are knowledge-based businesses, where if you look at the core competency of the charity and their underutilized assets, you can create a business leveraging those assets. And often what we're talking about now is creating an educational initiative out of a nonprofit that repurposes the information it's been applying in the pursuit of its mission every day, but now through educational programs, symposia, website programs, and the like. All of them revenue generating, diversifying revenue, but now optimizing and expanding the social footprint of the organization. So this is exceptionally important today when charities have to do more with less, and so does government. So government now is sanctioning L3Cs in 9 states and charities in any other state that does not have a specific enabling statute, nevertheless can create an L3C in one of the states that authorize it and then register that entity as a foreign business in its home state and now do business locally, much as one would establish a Delaware corporation and then operate in any other state because the Delaware law is hospitable to certain kinds of business corporations. So that's the L3C. It really depends on a tranched or layered capital structure, where frequently the PRI, or program-related investment, becomes the first layer in the capital structure. Before that, there was no money in this business. Now we have cash in the bank account and a foundation and its credibility standing behind the venture. With those ingredients and a sound business plan, the charity has little difficulty in securing additional investment from socially conscious individuals and others. If you look at the investment community along a continuum, some investors are exclusively looking for social returns. At the other end, some are looking exclusively for market-driven financial returns, and there are lots of people in between, socially conscious individuals, for example, impact investors and the like. Well, the tranche capital structure allows different investors to get the bargain that they're looking for, and the nonprofit, through its L3C, to deliver on that promise. So everybody gets the benefit of their bargain because they're looking for different things. The foundation is looking for a 0 or 1% return on its investments. The institutional investor at the top of the heap may be looking for 6 or 8 or 10% based upon its risk-reward calculus. But by having the foundation forego its returns, essentially what happens is a venture that even has modest financial returns, but the prospect of significant social impact, can give that institutional investor the return it is looking for as well. So it has the ability to use the foundation's money catalytically to attract investors of all stripes to a social venture that otherwise would not have been appealing to them purely on financial grounds. The L3C has certain requirements to make all this happen. The requirements include that the venture must be significantly or primarily for charitable purposes, and charity is defined here in the expansive way we think about it when we think about Section 501c3 of the Internal Revenue Code. Anything that can be a charitable purpose can be built into a for-profit venture by pursuing that same aim. The venture may not be using its money to support or oppose political candidates or campaigns or platforms or planks. Why? We're using tax-subsidized money from the foundation, and the government isn't about to favor or subsidize a campaign or a candidate to the detriment of another campaign or candidate. The venture must not be pursued primarily for financial returns, either income or the appreciation of assets. Why? Because if the venture, based upon its underlying financial assumptions, was forecasted to generate a significant financial return in its own right, then the government would say, well, go get your VC funding and don't rely on the foundation, which again is government subsidized. So you're really looking at the numbers and saying, is this something that needs a little helping hand to be launched? If so, the L3C may serve the purpose. Having said that, there is no cap on earnings, nor is there a cap on the appreciation of assets. Many L3Cs are already making a lot of money, and there's nothing wrong with that. They're putting that money back into the charity and allowing the charity to become more self-sufficient, more sustainable, more self-reliant, and serve more people better. So it's all about...
An example.
Yeah, so it's all about how the venture looks from the get-go before it launches to see if it qualifies. Once it does, we're in good shape. I'll give you an example or two, if I may. The very first L3C in the state of Illinois is an L3C called Civic Staffing L3C. It is a fair wage day labor business, which is a subsidiary of a 40-year-old 501c3 called HarborQuest. HarborQuest employs people outside the economic mainstream. And over its 40-year history, it's launched 5 different businesses. Almost all of those have been highly successful. When you ask the question, though, does a successful business need more or less money as it grows? People sometimes think, wrongly in my view, that the successful businesses need money at the outset, but thereafter become entirely self-sustaining and they don't need any more capital. The reality is, as businesses grow and expand their growth, they need capital to fund that expanded growth. A charity, because it does not have any equity, it has no owners, is constrained in its growth. So HarborQuest has always found itself with successful businesses, generating revenue, employing those people who are otherwise unemployable or underemployable, yet they're stopped. They're stymied by inability to get the capital they need. So we found a solution to that capital constraint, and that is through the creation of a for-profit subsidiary. And the for-profit subsidiary is an L3C. The ethos of the L3C matches the mission of the charitable parent, and we funded that initially through a grant received by the parent's charity and then deposited as capital contribution to the subsidiary, and then by means of a debt offering piggybacking that capital contribution. It's a Reg D offering from socially conscious individuals, as it happens. And now we feel that entity will never be capital constrained, because as a for-profit, we can always raise more money, whether it be debt, equity, or some hybrid instrument. We can securitize growth. So that's a good story. Now, what we're also seeing is, beyond this program-related investments construct that I've described, we're seeing all kinds of other ways of using the L3C. Let's suppose, for example, there are 2 or 3 operating charities that all have complementary missions, and at the same time, they each have a capital need, which may be similar. Let's suppose they're all at a point where they need to invest in sophisticated technology. They could, if they wanted to, address that need in a siloed fashion. Each could go out, spend money, buy the computer, the software, the programming, the talents, but that would be redundant, and they would be using resources 3 times what they needed to use. So now what we're seeing happen is the L3C can serve as a shared subsidiary of multiple nonprofits to serve a common objective. When they have one subsidiary, we can have the L3C define its governance structure such that the mission of each organization is being honored and respected. The technology, in my example, then can be acquired by the subsidiary. It could be funded by a PRI off the balance sheet of any one of the three parent charities, or they could fund it themselves. Doesn't matter for the purposes I'm describing it here. But now we have this subsidiary owning the technology, licensing it back, leasing it back, charging cost plus for the use. If there is outside funding, that revenue is used to meet obligations back to the investor or the owner. But the unusual thing that is occurring here, and the important thing strategically, is this. These 3 charities now see themselves as partners. And when they see themselves as partners as to this limited purpose, the next thing that inevitably occurs is they seek out other opportunities for collaboration. How else can we assist each other in pursuing our mutual aims? And all kinds of interesting, innovative solutions arise from that conversation. We're also using the L3C as a wholly owned subsidiary of one nonprofit. And why would we do that? We're doing it even if they don't need PRI money. Because from an asset protection point of view, if the nonprofit is going to be creating an earned revenue strategy, or taking a pre-existing business and depositing into an entity, we would always suggest, from a legal perspective, best not to house that in the nonprofit in the first instance, because if something goes awry in that business, it's going to taint the reputation of the nonprofit, and it's going to subject the assets and activities of the nonprofit to liabilities associated with the venture. So purely from a conservative asset protection point of view, we want it to be in a separate entity. If we put it in an L3C, by statute, we are now saying to the world that although we're operating this business as a for-profit entity, nevertheless, its purposes are limited to charitable purposes. So you needn't be suspicious about our motives or our sincerity in driving this business as a social enterprise, which itself is in furtherance of our mission. And the other thing that L3Cs are being used for is social purpose ventures that are totally unaffiliated with charities, have nothing to do with charities. We find that of those that are connected to charities, about half are tied to pre-existing charities, and about half the cases we create charities in tandem with the L3Cs. Why? Let me address this first. Because if you have a charity and a for-profit venture attached to it as a subsidiary or an affiliate, you have the ability to secure tax-deductible contributions and grants into the charity. You have the ability to sell debt or equity out of the for-profit and may also be eligible to receive grants. So you've optimized your funding, essentially tapping into every possible funding source. But you've also now, looking at this as one economic unit, have the ability to receive money where you can in the form that is appropriate to your donor or investor, and then move that money around that economic system seamlessly and tax efficiently as and when it's needed. So that's the charity L3C calculus. But now we look at the for-profit side where there is no charity. Why would a new social purpose business create an L3C? Even if there is no PRI in the cards, and many of them are in fact pursuing PRIs, program-related investments, nevertheless, they see a branding and positioning advantage in operating as a business which is constrained by statute to a charitable purpose. So they are sending signals to their investors, to their consumers, to their other counterparties that this is what we are, this is what we're made of, and this is why we're doing what we're doing. And those consumers will then tend to favor those ventures because they want to favor those ventures who have societal good at their core. So this too is part of the sustainability story, encouraging the consumer community to support those ventures that are doing the right things for the right reasons. So that's the L3C. Benefit corporation is a very different animal from an L3C. First thing is, an L3C is a specialized form of LLC, a limited liability company. The reason it's a limited liability company is not by accident. An LLC is itself the most popular business form among closely held businesses in the United States. It shields its owners from liability for the debts of the venture. It has enormous flexibility in terms of allocation of governance rights and responsibilities. And it also has a lot of flexibility in terms of tax planning. It can be a taxpayer in its own right, or it could be a disregarded entity for tax purposes. So lots of choices to the entrepreneur and his or her financial planners and advisors. The benefit corporation, as the name suggests, is first a corporation. So a benefit corporation and an L3C are mutually exclusive. You're either a corporation or you're an LLC, you can't be both. But the benefit corporation exists for an entirely different purpose. Whereas the L3C was really intended at the outset to assist in capital formation for social purpose ventures, the benefit corporation deals with a different issue. The benefit corporation is intended to mitigate the risk when management of a social purpose business is making decisions that do not themselves drive financial value for owners. The concern has been that management has a fiduciary duty to drive financial value. If it makes decisions that instead are accountable to stakeholders other than shareholders, shareholders could complain, and in a worst case scenario could sue management for having made a decision that was not in discharging the fiduciary duty of management. Now, there are in 31 states laws which mitigate this risk to one degree or another. These are often called stakeholder laws. However, in each case, they're imperfect. They often deal, for example, with takeover situations rather than day-to-day situations. So what the benefit corporation seeks to do is impose upon those corporations that elect to be covered under the statute of a state which offers them, the corporation would be undertaking to serve a general social purpose and may take on a specific social purpose. Now, what kinds of purposes we're talking about? We may be talking about serving a community or serving the environment or dealing with employment issues beyond merely hiring people to carry on a business. Some may argue that every business is a social enterprise because every business delivers a product or service that some segment of society needs or wants. Every business hires people, every business pays taxes. So a social enterprise really has within its DNA social mission as its reason for being. So that's a distinguishing feature. But here, when we're talking about a benefit corporation, we may be talking about rehabilitation of a community. We may be talking about having specific arts-related or education-related functions, for example. So the benefit corporation, by taking on these responsibilities and discharging them in a reasonable fashion, will be inoculated from a shareholder claim that they didn't do enough for shareholders. That's the theory of the thing. In addition to that, the benefit corporation is obliged annually to make available publicly on a website what it's accomplished in the last year in furtherance of that social aim, so people can judge it. It is also to measure its social performance against a third-party standard. Well, the statute does not prescribe a specific standard and is criticized by some because a third-party standard may be the subject of shopping around. Further, the benefit corporation has been criticized because it may create one risk in exchange for the one you're giving up. Namely, instead of having shareholders criticize management for not doing enough for them, some activist shareholders may say, hey, you didn't do enough for the environment, or you didn't do enough for unemployment. So you could have a situation where a shareholder buys one share, let's say, for the mere purpose of being a gadfly causing trouble. So
Has that happened?
None of this has happened. Understand that this is all brand new. So the reality is, in my view, the benefit corporation doesn't work very well for public companies, nor is it really intended for them. And in the case of private companies, the reality is, in my view, that people will all understand what the benefit of their deal is. And that is disclosed to them in the offering materials associated with their investment. And so I think there may be easier ways of mitigating this risk and perhaps more bulletproof ways of doing it. Having said all of that, one, we must applaud the innovation in corporate design. Two, we must recognize that most people who are adopting the benefit corp form are not really doing that for the technical reason I've described. Instead, what they are doing is embracing a specific ethos and codifying it within their corporate governance structure and communicating to the world who they are and what they're doing and why they're doing it. And for that reason, they are to be applauded. And I think that is the reason that most people who are looking at benefit corporations are, in fact, doing it. So we're seeing all kinds of emerging social enterprise forms, the L3C, the benefit corp. We have a benefit LLC now in the state of Maryland. So when Maryland enacts an L3C law, which it's not yet done, we can have a benefit L3C in the state of Maryland. Illinois has a benefit corporation law, which as we speak today has been passed by both houses of the legislature, not yet signed by the governor. It is expected he will sign it. It should take effect January 1st of 2013. So, there's lots of mixing and matching around forms and lots of combinations of forms, lots of collaboration between for-profits and non-profits. Lots of shared value, lots of blurring of sectors. All of this is to the good, because we ought to be agnostic as to business form. Instead, look at the purpose we're trying to achieve and allow the attorney to pull from his or her toolkit the best model for that business given its specific facts and circumstances. Design the best entity structure for that venture, From that will naturally flow the best deal design to fund that venture. And more attorneys, more and more social entrepreneurs, other stakeholders around this space are starting to understand that. There is greater buy-in than ever before about the need for self-reliance by charities, about the encouragement for social purpose businesses that are for-profits. There no longer is a stigma associated with a for-profit venture pursuing a social purpose. We're also overcoming the cultural stigma that nonprofits face when dealing with businesses, because nonprofit management is often perceived as taking things a little less seriously, not being held to the same standard, not requiring the same metrics. But here now, in both cases, for-profit and nonprofit, what we're doing is holding ourselves to metrics that are financial in terms of performance and social in terms of performance, looking not only at the activities of the social enterprise or the nonprofits, but those outputs that are legitimate proxies for social impact. Everybody is demanding that. Funders are, donors, investors, regulators, boards, management, and the information that collectively is being developed is of enormous empirical utility to those nonprofits that are going down this path, and more of them are for reasons of survival or for reasons of expansion. And both are important reasons. Governor Quinn recently appointed me chairman of the state task force on social innovation, entrepreneurship, and enterprise. And it's a multi-sectoral approach with a 2-year term where we are looking at very serious initiatives around questions of investments, questions of breaking down barriers for social enterprises, looking at models in other states and even other countries and bringing them here so that we can get the best of the world in terms of combinations of for-profits, nonprofits, where government can be helpful, where government needs to back away, and how this stuff can work most impactfully, most cost-effectively. Again, a case of doing more with less, a case of using leverage, and ensuring that everybody, irrespective of what their individual or institutional objectives are, is pulling in the same direction and harmonizing those objectives to ensure that everybody gets the benefit of their bargain along the way. And that's something that can be structured and is being structured every day.
Can you recall other places globally right now where that is happening?
Yeah, well, you mentioned health. I'll give you another example, and a different kind of example. In the state of Maine, the organic dairy farmers were having a devilish time trying to get their product to market. They were being squeezed out by corporate agriculture. This is a problem all over the United States and all over the world. So what was done? An L3C was created for what is now known as Maine's Own Organic Dairy, L3C. No, I did it wrong. Maine's Own Organic Milk, L3C. The reason I had it corrected is because the acronym is Moo Milk. And they received a grant initially. So these all don't begin with PRIs. They initially received a grant from the state of Maine Department of Agriculture. And it was set up in unusual form. We could do it right here in the state of Illinois under our statute. It's a co-op. It's a dairy co-op. We're looking at other co-op applications using the L3C. So there's lots of different governance approaches, different ways of sharing economics, different ways of divvying up the pie, inviting government in when government can be helpful, being self-sufficient where government may introduce additional costs or bureaucracy. So all of this really is a full appreciation and respect for what is the mission and what is the best way to accomplish that mission. Looking not at the charity from the point of view of where it's at and how it incrementally can grow into this, but rather looking at the charity from the point of view of what can it be. Don't be constrained or limited by a specific series of steps. Look at what it ultimately can be, what mission can it serve, and then reverse engineer to create the building blocks today that over time can get the charity where it needs to go. You go as far as you can see and you see farther. How this can be integrated into the developing world. There's a specific tax rule in the United States, and that rule says that if an activity is deemed charitable when performed in the United States, it is ipso facto charitable when performed outside the U.S. That allows us to use an L3C all over the world, for example. That allows us to secure U.S. foundation funding all over the world. And when the foundation makes a program-related investment, it counts against its 5% distribution, even if that's made in Africa or Haiti or anywhere else in the world that is in need. So we're creating L3Cs. Sometimes we'll use a second or third tier subsidiary in each of several countries. In Africa, for example, we may do it in partnership with an NGO in countries. The reason we may want to have a second-tiered subsidiary or even a third-tier subsidiary is from a regulatory point of view. We don't want the local government to be scrutinizing the global activities of an L3C. If they have a legitimate interest in seeing what's going on in their own country, fine. Let's confine that activity to a separate entity, and then we may do so in partnership with an NGO. There may be political reasons, there may be currency reasons, there may be other reasons to confine risk to a specific entity. But this is something that's being done now. The U.S. is taking the lead. The U.S.'s interest in social enterprise transcends that of other countries. And I'm very actively involved in an organization called Social Enterprise Alliance, which is the membership organization of social enterprises all over North America. And I chair the Chicago chapter of that organization. We happen to be the largest and most robust chapter in the entire network, because Chicago is a hub of social innovation. And if I had my way about it, it's going to be the hub of social innovation in the country and in the world, because we have world-class universities here, we have great thinkers, we have wonderful corporations that are socially conscious, we have social enterprises and nonprofits that are highly committed in their leadership and in their thought leadership. So you bring together those forces and put them in the context of the need that exists, and look at this city and its environs and the help that is available and the help that can be delivered through business models, and it becomes intuitively the right way of helping getting this job done. Anybody who is interested in setting up, let's say, a social enterprise rather than preempting a specific form, if someone is interested in, I would encourage the very same steps one would pursue in setting up any closely held business. If this is to be derived from a nonprofit, I encourage nonprofits to think strategically about where they're at, where they're going, and where they see themselves in the future. And I spend a lot of my time speaking to nonprofit boards about what are your core competencies, what are your underutilized assets that we can then shape into an earned revenue strategy that can diversify your revenue and start using philanthropy catalytically rather than in an old-fashioned one-off check way where that is not recurring. That's not something that's sustainable or you can count on. So to the extent that the charity as a fiduciary wants to start looking at ways they can become more self-reliant, I'm delighted to speak with those charities all over the country, and we do this globally. Similarly, for someone who is not associated with a charity, if they're interested in setting up a social purpose business, that's an additional dimension to the same business planning process that one would undergo in setting up any business. And I'd be happy to chat with anyone who's interested in exploring those possibilities. And I would applaud them for their leadership, and I would encourage their efforts. But again, setting up any business, obviously, is not easy, is not automatic, and the fact that this has a social mission doesn't make it easier. In fact, in some ways it makes it harder, because now you have two different kinds of bottom lines you have to meet. But there are questions of capital, there are questions of talent, there are questions of capacity and bandwidth, there are questions of market and condition and competition, and all the kinds of things you need to do in order to plan this out in terms of business planning, financial planning, strategic planning. And again, we're happy to help those people as well. This is what we do every day.